Once again, good morning all. Thank you for joining this webinar. So we all know the topic for today's webinar is the secret to long-term wealth, that is structure plus discipline, right? Let's start. So let's begin by looking at the bigger picture. So see, the secret to long-term wealth is just about picking right stock or timing the market. It's about understanding how the macro environment and behavioral aspect, like how you should stay disciplined and building a structure that works through every market phase. And right now we are in what many investors call that is like market going nowhere. So this phase is something also called as consolidation phase, by the way, right? So let's unpack what this means and why it's important for your wealth journey during this consolidation phase, by the way. So market moves sideways. So instead of a sharp rally or a crash, what we see when the index fluctuates within a range, that's where the consolidation takes place. So in India, we have seen several such phases, by the way. So, for example, when you see from 2010 to 2013, Nifty hardly moved much. However, it was only kind of trading between 5,000 to 6,000 mark, by the way. Again, same thing you can see before 28, before the COVID crash, that is around 2018 to 2020. Market were more choppy and frustratingly flat, by the way. So what happens in these particular phases? Investor sentiment usually weakens. Yes, people feel like their money isn't growing, and some even exit the market in frustration. But historically, consolidate phase are like the quiet foundation which layers a big, strong thing for the investors, by the way. So when the breakout comes, it rewards those who are stayed patient. So right now, if you feel like the market is stagnant, you are not alone. But the history shows that uh, kind of like the next big leg of growth, if it needs to come, the market should consolidate before. So when we see specifically Nifty 50, the barometer for our Indian equities, if you look from 2008 to 2013, Nifty was almost flat after the big rally what it saw after the crash. But following in 2014 to 17, it again saw a big rally. But before that, we can see a good consolidation phase it has gone through. So the key lesson is something what I want to say is that this sideways market often tests patience, by the way. But the reward is more to the people who are more disciplined, by the way. So see, like SIPs during these flat years usually delivered surprisingly strong returns once the rally resumed. That's why it's very important to understand history helps you not to panic in the present situation. Now, let's shift today's macro condition. So let's look at some data. So if you look at inflation in India, it's something around 1.5 to 2 in that range we have. So it's roughly in the comfort zone of around 4% below, by the way. But when you see the RBI in their latest MPC meeting, they kept means they reduced their repo rate to 5.5%, which is really good for the businesses and so because they can increase their loan taking ability and so. So why this matters to investors? See, higher interest rate make borrowing expensive and slow in the corporate growth in short term. That's one reason why market consolidate also. At the same time, see fixed incomes like debt and FT become more attractive when the rates were really high. But see, history shows that once inflation stabilizes and the rate begins to ease, equities usually to starts their next bull journey, by the way. So it feels like stagnation today, but you need to be very calm for the next growth wave to come. So to finally say, see, investors psychology is like sideways market or like a psychologically more challenging than crashes. Yes, see, in crashes, fear is visible. People react and market eventually recovers. But in sideways market, it feels like nothing is happening. Yes, see, returns don't show up for months or even years. This is often leads to like chasing quick returns somewhere else or exiting your equities at a wrong time or worse, like neglecting investment altogether. You just get out of this particular field itself. So, but the disciplined investors who like they are like very kind of more patient, where the SIPs quietly accumulate more units at the stable price, where the asset allocation can be rebalanced during this particular period, where the patient truly compounds their wealth. So the secret is not reacting emotionally, but sticking to the structure you have built. So to summarize this everything, the macro going nowhere doesn't mean like your wealth is going nowhere. Consolidation phase are like a hidden preparation years. Nifty's history shows us patience pace. So by looking at the inflation and current interest rate explains today's environment is like hint for a future opportunity. And psychologically, that's where the structure and the discipline comes in. So with this context, we can move forward and explain the strategies that actually works during this sideways market. So now that we have understood the big picture of how this market moving sideways, so now let's discuss on something even more important, that is your goals. Most investors make the mistake of obsessing over only returns, by the way. Which fund is giving the best return this year? Which stock doubled last year? But the truth is, wealth is not built by chasing returns. It's built by aligning your investment with your life goals. It's something like that. That's the heart of goal-based investing, by the way. So I'll give an example, by the way. Imagine there is two friends, Ravi and Arjun, by the way. Both are 35 years old and want to save for the kids' higher education. So which will cost around 25 lakhs in 12 years, let's assume. So Ravi chases the Otis mutual fund every year. 1 year he makes 20% good, but the next year his loss is around 10%. He keep on jumping one fund to another fund. Whereas in Arjun case, on the other hand, he sits down and calculate how much he needs to save each month to reach 25 lakhs. He chooses a disciplined fund, whereas SIP strategy is more diversified, so he sticks on to it. So 12 years later, what do you think is more likely to meet the goal? Obviously, it's Arjun because he wasn't chasing return. He was chasing his goals only. Market reward mostly consistency and discipline for more than short-term excitements. This is very important, by the way. So that's why goal matters more. They give your investment direction, how you to move. So apart from that, there are a lot of other financial goals people used to have. One of the thing is the retirement, by the way. Many people underestimate how they will take care of their need. If you retire at 60, they need to live up to 85, right? The 25 years of expense without active income, your money has to work harder than you. Then only you can meet the 25 years, by the way. Then, of course, home purchase, one of the most emotional and significant financial decision, often requiring balancing between this down payment, TMI, and investment. So each of these goals has a significant timeline. So has some separate risk tolerance and investment strategy. So that's why linking your portfolio to your goals will give more clarity. So if your goal is like something like less than 3 years and so, you can kind of invest in somewhat more liquid oriented fund. If your goal is from like something in range of 5 to 10 years, like taking care of your education and so, you can have a good mix of debt and equity and so. If you have a goal something like retirement or something, even a big thing like you want to do something after 15, 20 years, you can have a good exposure towards equity. So this structured approach ensures you don't panic when the market stagnate or fall because your investment aren't tied to this timeliness. You are you're just not tied to this headlines. What you say, market crashed, everything is falling. You're not concerned about that itself because you're only fixed your goal. Okay, it will take time to reach my goal. I'll be reaching my goal. That's the mindset you'll have. That's very much important, by the way. So again, let's visit what we discussed earlier, the stagnation period. These are the times when the discipline is tested, by the way. Yes. When you don't see returns for 2, 3 years, it's easy to say, what's the point? It's me stop my SIP. But goal-based investing protects you from this mistake. If you know that you're investing for a child's education in 2035, then you don't care if the market is flat in 2025, right? You stay invested because the goal hasn't changed. That's emotional discipline, the ability to ignore short-term noise because you're anchored only to the long-term purpose. That's your goal. So this is the power of goal-based investing in the simple but profound. So goals give you more direction and a goal shapes the right investment strategy for you, and a goal helps you to stay disciplined during this stagnation, right? So remember, chasing return is like running on a treadmill. You feel the effort, but stay in the same place only. But goal-based investing is like walking towards a destination. Every step, what you take will make you closer to your dream, by the way. So now that we are seeing the importance of goal-based investing, so let's look at most powerful tool that helps us to track uh, to reach our goal, by the way. That is the SIP, the systematic investment plan. So many investors think that SIPs are only useful in risk rising market, but the truth is, see, SIPs are the best when the markets are flat. Yes, when it's volatile or even going down, that's when they quietly work in your favor. Let's start with the concept of rupee cost averaging. See, when you invest in a fixed amount every month, say 10,000 rupees, you buy more units when the market is going down and fewer units when the market is high. Over the time, this average out your cost of purchase. Example, let's take a X as a mutual fund. In a month one, you purchased for 50 rupees now where you got 200 units. In the second month, the NAV has fallen to 40, but you are able to purchase 250 units. So in third month, the NAV rises to 55, where you are able to only purchase 181. So now your rupee kind of average cost is lower than the current market price. This is the beauty of SIPs. They automatically buy more when the market is cheap. It's like a built-in safety mechanism that removes the timing risk, by the way. So now here's the counter initiative. What I want to say. See, SIPs actually perform best when the markets are flat for some time. You will think why? It's because during the stagnation period only, you're accumulating more and more units at a lower price. You think when the market is up, you need SIP is kind of only able to get less units, but in the stagnation period, you'll able to create lot. Your number of units will be more, by the way. So when the breakout finally happens, all those accumulated units suddenly multiply in value, right? Think of it like a spring being compressed. The longer the market stays flat, the more energy it builds, by the way. So when the market finally moves up, SIPs benefit more from this, by the way. So compounding isn't just about returns growing. It's about the discipline of staying invested, even when nothing seems to be happening. Like if nothing is like happening in that particular period, also you should be very much calm. That's how these SIPs play their role in this stagnant market, by the way. Oh, okay, we can take another example. If you invested around 10,000 rupees for 10 years at 12% return, you will invest 12 lakhs at the end. You'll be end up with around 23 lakhs. Okay, that's almost double. But if you extend the same SIP for 20 years, you invest 24 lakhs, but your wealth has grown to 75 lakhs. Same thing at the 30 years period, your investment is 36 lakh, but it's grown to 2.9 crores, which is very high. So the stagnant phase don't break compounding. They strengthen it because your discipline during those tough years is what gives compounding the raw to work with. So let's revisit the history again. So we have seen the Nifty as mostly flat during the 2015 phases and all. Many investors lost patience when stopped their SIPs. But those who stayed invested kept accumulating units at a lower NAV, by the way. Then in 2017, when let's see, like the market took off and the SIP investors suddenly saw their portfolios jump. Here's the reason: SIPs are not about timing the market, they're about time in the market. That's very important. So if you have stopped your SIP, let's say in 2016, thinking nothing is happening, you would have missed the 2017 rally, by the way. So if you have stayed consistent, you have harvested the full reward, by the way. So the essence of SIP is consistency, by the way. So the rupee cost averaging, it works at the same time. In this consolidation phase, your return also will keep on increasing when the particular period has come to an end. So this is something what very important everyone needs to know in your wealth journey. Okay, now let's move to one of the most important secret for long-term wealth, that is asset allocation and diversification. See, we have discussed SIP is an engine. See, then the asset allocation is like a steering of the wheel. It determines the direction of your journey, by the way. In fact, so some studies shows that over 80% of a long-term return depends on not how the stock picking or timing, but on your asset allocation only, by the way. Yeah, it's true. So many investors in India think that wealth creation is only equities, but it's only the half of the picture. See, we have some other asset classes like fixed income, which give more stability. Think of it like an anchor for your portfolio. See, when the equity markets are volatile, fixed income provides a good predictable return, right? And we have precious metals like gold, silver, and all. They act as a hedge when the inflation rises, or we are seeing this global uncertainties due to war and so, which hit. But the gold protects the purchasing power during that particular period. Look at 2022 when the equity market crashed due to COVID. Gold touched new highs and all because it's like act as hedge during this particular period and all. Even you can see the foreign equities also like US market, other emerging countries also. So having a good diversification is very important in your journey of investment, by the way. Diversification across these asset classes ensures that when one engine kind of stops, like in a plane, but the other engine is there, which keeps on running to reach your destination. That's something how this diversification works. See, when the markets are going nowhere, like we have discussed earlier, that's actually the best time to look at a portfolio where you can rebalance, by the way. Um, let's take an example. If your asset allocation is something like 60% equity, 30% debt, 10% gold return. So if you are underperformed and fall into 50%, you can stop up equities to bring it back to 60%. If the gold has shot up and become 20%, you can trim it down and deploy it into equities. This disciplined rebalance forces you to buy low and sell at high without emotions or without guesswork, by the way. So the sideways market are not wasted years, by the way. They are like a golden opportunity periods to strengthen your portfolio. Think of diversification, something like shock observer in a wealth journey. If your portfolio was fully 100% equities during this 2008 crash, just think, you would have seen a 50% fall. But when you are in a diversified portfolio, let's say 50% equity, same like 30% debt, 20% gold, you would have cushion to fall, which will be around only 25%. The ride becomes something like much smoother during this diversification phase. You won't even panic and you stayed invested, and that's what ultimately delivers to you this thing, by the way. Okay, then again, I can give another example, by the way. Let's take two friends right now, Ramesh and Suresh. They started the investment in 2005. Ramesh put everything in equities. Suresh divided it into some multiple asset classes like equity, debt, and gold. When the 2008 crash came, Ramesh panicked, stopped his SIP, stayed out of the market for the 2 years. Suresh, on the other hand, saw lesser losses, stay calm, even rebalanced by buying more equities during that particular crash time. So by 2015, Suresh's portfolio was much larger than Ramesh, not because he chased higher returns, because the diversification gave him emotional stability to stay in the course. So here's the big reason. Asset allocation is a foundation for wealth. And the sideways market are the right time to rebalance, by the way. Even see, diversification protects you from the shock and keep your journey smooth. What we saw with Ramesh and Suresh right now. Remember, wealth is not built by chasing returns. It's built by surviving the long enough to enjoy the compounding. And asset allocation ensures you to survive every market cycle. So let's talk something that's not exciting, but it's absolutely very essential for everyone. That is emergency fund. Emergency fund, by the way. See, think of it as like a financial seatbelt. You don't think about it every day, but when uncertainty strikes you, it saves you, by the way. Whenever the markets are volatile or your income flow is uncertain, and emergency funds give you a breathing room. Instead of selling your investment at the wrong time, you can rely on this particular caution fund, by the way. So let's say take during your COVID in 2020, those who had emergency fund could have managed expenses calmly, while others where they are forced to panic sell their equity at a low. The thumb rule, what I want to say is that keep at least 3 to 6 months worth of your living expenses. For example, let's take a family with the 50,000 monthly expenses. That means their safety net, something they should have around 1.5 to 3 lakh in a safer liquid fund or something where they can take it when they require them, by the way. So if your job is like more like less stable, or you have a dependent, or like you aim for a kind of a higher side something, without a cushion, you might be forced to break your SIPs or redeem mutual fund that is in a downturn. But see, if you have an emergency fund, you stay more invested and let the compounding work. This one habit alone can protect your wealth creation for a long period, by the way. So where you want to park this money, I've said already, you can park in something where this fund can be taken within a T+1 or within a day, so that you can take some efficient steps during this caution period, by the way. So market often go through this long consolidation, so they don't also rise and fall more dramatically. So this is what this particular period what we are seeing right now. So in this such time, many investors lost their interest and stopped paying attention to the thing that is called this periodical review, because like most important thing is this one: when the market is flat, it may look like nothing is happening, but in underneath, you can see that individual sectors or asset classes are moving very differently. See, for example, in the last few years, you have seen that IT may be fallen, but you can see capital goods have rallied. A review helps us to spot the shifts and ensure our portfolio is aligned with our long-term goal instead of shifting to the small silence what we are seeing right now. So over the time, the market movement change your asset allocation even if you don't touch your portfolio also. Yes, say, for example, if you started with 60% equity and 40% debt, if your equity underperforms for 2 years, you can assume the asset allocation may be quietly slipped to 50-50. Without review, you may end up either taking something like less risk or more that you originally what you planned as per your risk appetite, you have not fulfilled that, by the way. So the flat markets are something like a great time to rebalance during this particular period. So imagine gold and fixed income doing well while equities remain more stagnant. By booking some partial profit from this, what we saw right now, performing and reinvesting them in the most undervalued equities, you position yourself for the next growth cycle. Yes, that's the thing. So many investors who rebalance during this particular phase, what I said earlier, were doing really good during the strong bull, which is followed in the upcoming period, which means like when the stagnant market was there in earlier, when they did kind of a good reallocation and adjustment, they really performed well in their strong bull run, by the way. So one of the biggest risk is neglect. Investors assume SIPs are like autopilot. No. So no review is needed. They think like how means like SIP means no review is needed like that. But this neglect can lead to duplication of fund, missing underperformance, carrying like a more debt weight investments. A simple annual review, or checking how the allocation is there, rebalancing keeps your money working harder during this particular sideways market, by the way. So, as we reach to the final part of our today's discussion, so let's talk something which is very close to us. That is the Milestones to Wealth program. We call this M2W. So, everything we have discussed today, like this goal-based investing, SIPs, diversification, reviews, comes together under one structured framework. That's exactly what M2W is designed for. See, M2W is built around the idea that wealth creation doesn't happen overnight. It happens through milestone by milestone. Whether your milestone, something like building your first 5 lakhs as your corpus, or buying a house like what we discussed earlier, like child's education, or building your retirement need, every step matters. M2W helps you define these milestones, plan the right investment, and most importantly, it's like it will make you to be stay disciplined in achieving them. By the way, it converts this vague dreams into like more concentrated one where it can be tracked through milestone. So most investors invest without a clear goal, like what we saw earlier, just chasing returns. But with M2W, we reverse the approach. We begin with goal mapping, identify your short term, what is your need, your long term, what's your need. Then we build a disciplined investment plan, combining SIPs, asset allocation, and periodic reviews. This structured approach ensures that no matter how the market behaves, like up or down, even the sideways, what we are seeing right now, you're always progressing towards your milestone. It's nothing about beating the market every year, but about reaching your life goal without any stress. Let me give a simple example. Many investors ask, can my small savings really grow into something meaningful? That's something we used to get. The answer is yes. Suppose you start with 5 lakhs and continue disciplined SIP with the right allocation across gold, equity, debt, and so you can aim for 1 crore over time. That's exactly the kind of journey M2W is designed for. We are seeing investors who started very small, maybe 10,000 as a monthly SIP, and they stay consistent for 10, 12 years. And today they're sitting with a good milestone worth 50 lakhs or more. So this program is about not speculation, it's about compounding and discipline. So now you may wonder, why do I need a program like M2W? Can't I just do it on my own? See, the truth is most investors fail not because they don't invest, because they don't stay disciplined. They stop SIPs during market falls. They chase the hottest stocks or they neglect their portfolios for years. That's where the professional guidance matters. With M2W, we don't just give advice, we walk with you. See, we ensure your milestones are more are like realistic, your allocations are balanced periodically, and your reviews are done timely. In short, see, we ensure like kind of not to make you lose any big dreams. That's the thing. So to sum it up, M2W is something like turning your dream to milestone, where this M2W is more concentrated into structure, discipline, and guided to a journey from like anything from 5 lakh to 1 crore and beyond. It's just possible. It's very achievable, by the way. So that's the message I want to take you all guys from this particular webinar. So it's discipline plus structure. That's with M2W. Will never walk this journey alone. So thank you guys for attending this webinar. Now we can go to the Q&A section.